We spoke last time about the taxation of flow-through entities during asset transactions. This week, we're going to talk about the taxation of C corporations during asset transactions. This will lead us to the dreaded topic of the built-in gain. Let's think for a moment about the taxation of a C corporation. We know that there's two levels of taxes. First at the corporate level, and then at the individual level. But quite often you may not think about this while operating your business because you're able to get the cash out of the corporation. Maybe you overpaid yourself a salary, owned the real estate and overpaid rent, or you put your spouse and your kids on the payroll. Voila, your corporate income was zero, but you paid yourself plenty of money along the way with only one layer of taxation. But in an asset sale of a C corporation, the value of the sale is going to be sucked into the profit and loss statement. The sale price is going to be much higher than your annual salary. So your CPA may not be able to employ the strategies that worked previously. That means the corporation will need to pay corporate income tax on the proceeds before they can be distributed. And of course, when the owner distributes, the funds are going to be subject to a second layer tax at the personal level. So let's take a look at a hypothetical example to see the potential impact. We're going to be looking exclusively at the federal tax rate, so we're going to ignore state taxes and the net investment income or Obamacare tax. The high end of the federal tax rate is 21%. An owner may then need to pay an additional 15 to 20% once the funds come out of the corporate entity. For every $1 million of gain, that equates to $350,000 to $400,000. We're going to compare this to a flow-through entity where you're only taxed once. If you remember how the allocation of purchase price works, we'll be taxed here at a blend of the ordinary income and capital gains tax rate. For our example, we'll assume the blended federal tax rate comes to 25%. So in this example, we're looking at taxes of $250,000. That's well over $100,000 of savings. Could be 40 to 60% difference. It's certainly a big enough discussion to have with your CPA about whether a C corporation is the corporate entity structure given your current operation and exit plans. Let's assume for a moment that you call your CPA and they indicate that based upon your current needs and your exit plan, that you shouldn't be a C corporation. Can you just convert your corporate entity? We're going to talk about that next time.